Thank you for joining us this evening via Zoom for our Coastal Wealth webinar on our timely topic, investing during an election year, with our special guest speaker, Rich Antonucci, who is from Prudential. Rich is a graduate from the University of Miami and has been in the industry for almost 20 years. He is a true expert on retirement planning and income solutions. Rich is a recipient of many top industry awards. Please welcome my friend, Rich Antonucci.
Thanks, Neil, for that great introduction, and good evening, everyone. Thank you for joining us. As Neil mentioned, my name is Rich Antonucci. I'm the Regional Vice President at South Florida, covering both South Florida and Central Florida. And we have a very timely topic for you today, a pretty interesting topic. We're going to be talking about how the political landscape is affecting the investment landscape and will be affecting the investment goals of everyone on this call. So we've got about 30 minutes worth of content tonight, lots of great information. I'm going to go ahead and jump right in. Everyone on the call is in a listen-only mode. I'm going to try to save some time for questions at the end. If you have a question at the end, I'm going to open it up for questions. Just hit the raise hand button, and hopefully we'll have time to take a few questions. So I'm going to jump right into the political content I'm going to be covering. So hopefully everyone can see the screen here. It's pretty interesting in that when we scheduled this topic, we thought we would have had more resolution around the political aspect of this presentation. A lot of things are still in flux, but we still thought it was important to have this conversation because there's really two topics we're going to cover tonight. We're going to talk a little bit about the political landscape, and we're going to keep the political comments aside. This is not going to be a political discussion on one side or the other, but we're going to talk a little bit about the political landscape, most of which has not yet been decided. But the more important discussion is how the political landscape affects our finances, affects our economy, and what are the steps you can be taking if you're a Coastal Wealth advisor. What are some steps you can be taking for your clients? If there are any clients on tonight's call, what should you be discussing with your Coastal Wealth advisor in terms of strategies and protection? Okay, so I'm sure a lot of us have been watching what's been going on politically in this country. This has really been an unprecedented year and a weird year for a lot of different reasons, and the political landscape has been no different. So what you're seeing here is just a presidential snapshot. You know, the countries that are traditionally solidly Republican, like Texas, for example, the states that are traditionally solidly Democrat, like California, for example. And then the yellow states are what we call up for grab states. And as you'll note, those states are Florida, Pennsylvania, Ohio, Georgia, Michigan, North Carolina, Arizona, Wisconsin, Iowa, and then a district in Nebraska and a district in Maine. Most of those states are still in contention, and we all know what's going on there. There have been a lot of accusations of voter fraud, a lot of battling back and forth. It will be really interesting to see how that all shakes out over the coming weeks. In terms of the presidential polling, I mean, there's a lot of discussion about how accurate is the polling. I think the pollers really lost a lot of credibility in 2016, as well as 2020. You could see that the polling definitely has favored Biden, just like it favored Clinton in 2016. You know, it had Clinton winning Arizona, but also winning Florida, winning North Carolina, winning Michigan, winning Wisconsin, and winning Pennsylvania. We're going to have to see how that all shakes out. It's not just about the presidential election, however. It's also about the House and the Senate. Okay, so a path to the Republican majority in the House is very narrow. Okay, very unlikely. Everybody agrees it's very unlikely that the Republicans will flip the House, but they did gain some seats. Now, in a general election, it is highly likely that Democrats retain control of the House. Historically speaking, that's the way it's always been. 2020's been no different. Now, the Senate is a little bit more of an interesting case. The Republicans are hanging on to the Senate by a razor-thin majority. We've got some things coming up in Georgia that will make, in terms of runoff elections, that will make it very interesting. The momentum of the presidential election often cascades into the Senate, though a supermajority for either party appears to be unlikely, right? So that's, basically the Republicans might retain it by a thin margin. The Democrats might take it by a thin margin, depending on what happens in Georgia. But a supermajority either way is very unlikely, which makes it hard to get things done. Certainly, according to this data by Goldman Sachs, momentum is building on the left, right? So we've got here the odds that Democrats will win in 2020. Again, a lot of these predictions turned out not to be true. Again, political feelings aside, that just happens to be a fact. A lot of people are concerned about progressive policy implementation. The reality is that's really going to be limited to executive orders and reconciliation. And you can see here some of the things that can be done by executive order. So a lot of the progressive left discussion is not going to be able to be done because they're not, unless they control the House, the Senate, and the White House, which some people feel is unlikely. But there are things that can be done through executive order. Healthcare, the Affordable Care Act, right? That can all be done during executive order. The environmental stuff, fracking can be banned, stricter regulations, stricter standards. Education, regulation for for-profit higher education institutions. A lot can be done to put pressure on corporations and the finance industry, trade policy, immigration. Those are all things that can be done through executive order, and the markets will closely be watching all of that. And then, there's a discussion to be had about platform versus policy. Grandiose pledges, the way it sort of works is the pledges are very grandiose during the primaries. A lot of promises are made. They tend to be a little bit more moderate during the presidential election as people feel like they have a hold on their base, and now they're trying to get more general popularity. And then the legislation actually tends to be even more moderate than that, right? So, and we can see here a history of that. In 1932, the Democrats ran on balancing the budget, and what we got was the New Deal and massive new spending. In 1988, the Republicans ran on no new taxes, and we ended up with a new income tax and luxury taxes. In 2004, Republicans ran on returning to the moon and beyond. We did see a NASA budget boost, but there was no moon plan. In 2008, the Democrats ran on the public option healthcare, and a lot of work was done there. We ended up with the individual mandate healthcare in the Affordable Care Act. In 2016, the Republicans ran on border security. That's still in the works. And 2020, a big part of the platform was voting rights, infrastructure, and tax reform. Again, a lot of things uncertain there. It's been really interesting to watch how the markets have been reacting. Typically, markets have pretty strong predictive power leading up to elections. And the thing that elections like more than anything else is certainty. What markets don't like more than anything else is uncertainty. So it's been really interesting to watch how markets have been reacted. Never mind the fact, aside from the political backdrop, there have been a lot of other things going on this year. It's been a really weird year for us for a lot of different reasons, and the market's been, no different. A lot of very smart people and very smart economists are having a lot of trouble making sense out of what the market's doing. And we're going to talk about that a little bit more in terms of what that means for everyone on this call. So I'm going to switch gears a little bit. And what I'm going to do is I'm now going to pull up a PowerPoint that's going to go into a little bit of a deeper discussion about the economic environment and some steps that can be made for everyone on this call in partnership with your clients and in partnership with your financial advisors at Coastal Wealth. And again, folks, if you have any questions, go ahead and jot it down. I'm going to save some time for questions at the end. But I think it's important to take away from this discussion, if there's one thing you take away from my political discussion, it's that there's a lot of uncertainty in the markets. There's a lot of uncertainty in the political landscape, and it's easy to get distracted. But what I'm going to encourage everyone to do on this call, whether you're a client or a financial advisor, take a step back, take a deep breath, and let's focus on the financial plan, and let's implement the financial plan, because a sound financial plan will always win. And a sound financial plan is a long-term plan. It doesn't worry about what happens in an election year or over 4 years. Okay, so we're going to do that. We're going to take a step back, and we're going to talk about some strategies that you can implement in your financial plan to be insulated no matter what happens with the election, no matter what happens with the market. Anytime I'm giving any type of presentation to clients or to financial advisors, and I do a lot of them, just to give you a little bit of background on myself, as Neil mentioned, I'm the regional vice president at Prudential. I've been with Prudential for 20 years. It's my job to work with financial advisors, helping those financial advisors build financial plans, specifically around retirement planning and lifetime income planning. So I consider myself almost as a consultant to financial advisors. And doing this for 20 years, I've spent a lot of time studying the economy and what's been happening in this country. And the really interesting thing to me is how the pyramid of retirement has changed for Americans. If we go back as recently as 25 years ago, the foundation of a successful retirement was the pension. The vast majority of Americans worked for a company for 30 years. At the end of 30 years, you got your gold watch and you got your pension. The pension was supplemented by Social Security, and then maybe you had a nest egg, maybe you didn't. But even if you didn't have a nest egg, you could still live a very comfortable life in retirement. Today, very few Americans have pensions on which to rely. Today, the nest egg is the foundation of retirement. And when I say nest egg, what I'm referring to is retirement assets, right? IRAs, 401ks. So the nest egg is the foundation of retirement. Social Security supplements the nest egg. And again, very few Americans have that pension on which we can rely. So the reality is the burden has now been placed on us, right? You know, retirement assets, IRAs and 401ks are great vehicles for retirement planning, but they don't have guarantees. A pension is guaranteed. Every year that you are alive, you know your check will show up in the mailbox. That's not true with an IRA or a 401k. The burden has now been moved to us. And so it's one of those things that have to be considered during the financial plan. You have to consider the likelihood that you'll face a bear market. And studies tell us that on average, we will all face a bear market sometime during our retirement. Since 1945, there have been 15 separate bear markets. Of those, only 3 of those bear markets have had losses exceeding 40%. The median drop in the equity markets was 26%. And on average, retirees face a bear market every 3.5 years. So you need to be prepared. This year was certainly a volatile year. And by definition, this was a bear market. If we look at the first quarter of 2020, it was the worst quarter in the equity markets ever. Now we're looking specifically at the S&P 500, which is a stock market index. And for many people, it's considered the best barometer of stock market health and performance. Okay, we saw the biggest drop in value, the worst quarter in the S&P ever. But it wasn't just the equity markets that were affected. The volatility that we saw in the equity markets really pales in comparison to what we saw happen to U.S. Treasury yields. The 10-year U.S. Treasury dropped by 70%. an unprecedented change in value. And that's affected the fixed income investing. It's affected CD rates, money market rates, bond yields. So we've seen a lot of volatility in both equity markets and fixed income markets. Now, I love this slide here because this slide talks about emotional investing behavior of the average Americans. And we all do it, folks. We see the emotional investing cycle that runs from optimism to euphoria to fear to surrender back to optimism. We are by nature emotional beings, and it's because of these emotions that many of us, try as we might to do otherwise, tend to buy high and sell low. And that's the reason why the average investor receives much less return than types of investments. So what we have here is the average 20-year annualized return of gold, of oil, of the S&P 500, of a 60-40 blend of stocks and bonds, of a bond portfolio, of the EFA index, of homes, even of inflation of 2.2%. Now let's just focus on the S&P 500. Over the last 20 years, the annualized return of the S&P was 5.6%. Yet the average investor received 1.9% because those people were investing emotionally and thinking, what do I do? Do I buy? Do I sell? What's going to happen with the election? What's going to happen with oil prices? You also have to consider the mathematics of loss, right? We see a lot of people that lost a lot of money in the first quarter of this year, didn't stay invested, right? Went to the sidelines, went to cash, missed the run up, and now they have a lot of ground to make up. Well, it's important to remember that for every percentage point that you lose, you need to make a bigger percentage point to get back to even because you're working off of a smaller number. In other words, if you lose 10% in your portfolio, you need to make 11.11% to get back to even. If you lose 20% in your portfolio, you need to make 25% to get back to even. If you lose 30% in your portfolio, you need to make nearly 43% just to get back to even. And that puts a lot of investors in a very precarious position, right? A lot of people today who are close to retirement age, at or near retirement age, really have just three decisions. Do I delay retirement and work longer? Or do I hope for unrealistic returns, right, 45% plus, to hope I can retire as planned? Or do I retire on time, but with a lower standard of living? And having done this for 20 years, working with the financial advisors at Coastal Wealth, it's my goal that no one on this call will ever have to make that decision. We're also in an interesting dynamic because historically speaking, as you got closer to retirement age and you got more concerned about equity volatility, you shifted money out of equities into fixed income, right? Because fixed income could deliver steady returns. But as the 10-year treasury has dropped, as interest rates have dropped, it's put a lot of pressure on fixed income. On average, over the last 10 years, the rate of return you would receive from your bank in a bank CD has dropped between 76% and 94%. And we've seen bond yields drop precipitously as well. So what that means is today, you really don't have anywhere to go. If you're moving money to fixed income, you're taking a lot more risk and seeing a lot less reward than ever before. And we know what happens. As interest rates rise, bond prices fall. Interest rates are at all-time lows. You know, we're floating between 50 and 75 basis points on the 10-year treasury. A lot of economists feel that we're in a low for long environment. I don't think anyone expects the 10-year to be 2% next year, but we do think it could get back above 1%. And if that happens, bond prices will fall. It's important to plan for that. I do a lot of presentations to clients with more specifically around challenges clients face in retirement. And one of the biggest challenges Americans face today is being prepared for healthcare costs. It's estimated today that on average, a healthy 65-year-old couple will need $285,000 to pay for medical expenses for the rest of their lives. For most of us, it's our second largest expense in retirement. Yet most of us are not confident that we can cover those costs. About 26% of Americans are very confident that they'll have enough money to cover even basic medical expenses during retirement, and that does not include long-term care costs. So if you're not planning for healthcare costs in retirement, you certainly need to be. It's also important to remember that our retirement today is much different than the retirements of our parents and our grandparents. Today, the average life expectancy of a couple is much longer than it ever was before. Today, 50% of couples over the age of 65, the men are expected to live to age 87 and the women are expected to live to 90. So what's happening is retirements are getting longer and longer due to changes in social behavior and advances in modern medicine. You need to be prepared for this longevity you might face in retirement. So there's a lot of challenges that we face today, right? We've got the political landscape, which is still uncertain. There's a lot of uncertainty there. You know, I was really thinking by the time we gave this presentation, there would be more certainty and we could be talking about how certain policy decisions would already be coming public. We would already know for sure who the president would be. But what's happened is because there's so much certainty in the election, we're not really seeing policy discussions on either side of the aisle. So there's not a lot of meat there to discuss. There's still a lot of uncertainty politically. There's a lot of, and because of that, there's a lot of uncertainty economically. There's a lot of uncertainty in the equity markets. There's a lot of uncertainty in the fixed income markets. So a lot of clients today are thinking about and planning for, how do I balance that risk and return? A lot of people are very concerned. The last recession of 2008 is still having an impact on many Americans' trust in a financial advisor. 73% of consumers in a recent study say their decisions are still based on what happened to them in the 2008 financial crisis. And over the last 30 years, bank CD rates have dropped about 95%, forcing consumers to invest in more risky, higher yielding investments, take on more risk, or accept lower returns. Which is why in every presentation I give, no matter what the topic is, whether it's Social Security planning, whether it's lifetime income planning, whether it's protecting your identity and securing your privacy, whether it's a political discussion, whether it's a healthcare discussion, I always tell people, if there's one thing I want you to take away from today's discussion, it's when we look at people who have successful retirements, the one constant is they're working with a financial advisor. Okay, financial planning, retirement planning is not one of those things you could tackle on your own. Okay, I wake up every day feeling really good about what I do. I get to work with the most successful financial advisors in South and Central Florida and help those financial advisors work with their clients and build strategies so people can retire with dignity. Now, as I mentioned, I work for Prudential. At Prudential, you might know us for a lot of different businesses, right? We're a life insurance company. We're one of the largest asset managers in the world. We're one of the largest pension fund managers in the world. We're also an annuity company. You know, one of the vehicles we use in partnership with Coastal Wealth is annuities. And when you think of an annuity, I'm not going to go into product. This is not a product discussion. I just want everyone to know that there are vehicles out there, be them annuities, be them whole life strategies. There are vehicles out there that can help add insurance to your retirement, right? We insure our cars, but we know there's about a 2.5% chance that we're going to have an accident. We insure our homes from fire. There's about a 0.3% chance of us having a home fire. But we all have car insurance. We all have home insurance. All of us, hopefully, God willing, will retire one day. But does everyone have insurance on their retirement? Okay. So we talked about a lot of statistics already. Income doesn't last a lifetime. If you don't have a pension, you need to be planning for your retirement. you need to be working with your coastal wealth advisor, and you need to be open-minded to strategies like whole life, like annuities, or other types of strategies that can help you secure your retirement. And the studies are out there that for many people, planning for retirement is their #1 financial priority. And I get it. I understand it. It's a big challenge. So we could see here the top financial concerns, whether you're a pre-retiree, right? Whether you're just planning for retirement or you're already retired, people are concerned about retirement planning. So folks, that's the end of my formal comments. I'm just going to take a minute and recap. We talked about the political environment. We talked about the uncertainty in the equity markets. We talked about the uncertainty in the fixed income markets. We talked about how the retirement landscape has changed. If you're going to take one thing away from my discussion today, it's the value of working with a financial professional. I said I was going to take 30 minutes. It's 30 minutes on the dot. So what I'm going to do now is I'm going to go ahead and stop sharing my screen.